So right now I am so excited to introduce Ed Slott to you. I know many of you know Ed from his contributions in the retirement planning and tax planning space. Ed is an encyclopedia of information about tax matters. And the best part about Ed is that he brings so much enthusiasm to the topic of tax planning. He really makes it a lot of fun. And Ed's latest book is called The Retirement Savings Time Bomb Ticks Louder, which was kind of a bestseller. It did really well on the charts. I look at the retirement charts. It did well. So Ed's focus and the focus of his firm is educating financial advisors about tax matters. They do seminars for financial advisors, but Ed knows that the Bogleheads audience is pretty tax savvy themselves. So we thought he was a really good person to speak to you. Ed, as you know, is a big enthusiast for Roth. Anything, paying tax now in exchange for tax-free withdrawals later. But he'll talk to you today about a lot of different topics, and he'll also take your questions. So the note cards are on the table. Mike Piper will be curating the questions. We'll have people walking around picking them up. So thank you for welcoming Ed Slott to the stage. Thank you.
Well, welcome. You ever hear the saying, less is more? Do you get out much? I need a live audience. Why don't we try this? Why don't we all join hands and contact the living? You ever hear the saying, less is more? Yeah, well, less is not more. Less is less. So in the first 10 seconds, you already learned something. Less is less. But when it comes to taxes, less is more. The less you pay, the more you keep. But to keep more and pay less, you have to have a plan, which few people do. Most people have most of their money in tax-deferred accounts. This money has not yet been taxed. IRAs, 401ks, because that's kind of the way we were brought up. Roth IRAs came along much later. Now, I know this is an investment conference, but I'm not an investment guy. I'm a tax guy. But because this is an investment conference, I will give you my one big investment idea, which hasn't been covered anywhere in this program. Invest in taxes. I got that idea from Henny Youngman, the old comedian. He said, I'm putting all my money in taxes, the only thing sure to go up. He was right. He was right. That's the key to all good tax planning, if you think about it. Remember, this money in IRAs and 401k, it's not if but when. This money will be taxed at some future date, maybe on a higher balance at a higher rate. So it's when you pay the tax. And tax planning, the foundational principle of all good tax planning, it's so simple and missed by so many. And I call it my always rule, because it's always true. Always pay taxes at the lowest rates. That's it. Always pay taxes at the lowest rates, even if it means paying taxes before they're required. And that's the big stumbling block. That's a major psychological hurdle. And I know that as a CPA and accountant. From day one in school, we were trained, hardwired. Every accountant that went to school was trained. Never pay a tax before you have to. Always defer, 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 put it off. In fact, if when you were a kid and your mother told you to do something and you said, not now, Ma, I'll do it later, you would have become an accountant because you were trained to put things off. But when Roths came out, I became a recovering accountant because I saw the big picture. There's a corollary that goes along with always pay taxes at the lowest rates. Never waste a low tax bracket. So now with the OBBBA, One Big Beautiful Bill Act, now it's interesting, this big act of 870 pages has nothing in it on IRAs or 401ks or retirement accounts, nothing. But indirectly, with all this new slew of deductions, it has a part. It can help you take this money down. That's what I'm talking about. Most people have too much money, heavily weighted in taxable money. And that IRA is a growing, building, compounding debt. Remember, that money has not yet been taxed. Your IRA is an IOU to the IRS. That's what it is. We want to change that and have the growing, building, compounding work in your favor, tax-free, like a Roth IRA. And you have two great things working for you right now. You have high markets, means the value is going up, but that also means Uncle Sam's share is going up, right? Anything in an IRA, remember you have a partner on there, Uncle Sam. But there's no obligation to pay more than you have to Uncle Sam. And I don't know if you know this, he's not even your real uncle. So there's no obligation there. So you have a couple of things going on now. You have high market values and historically low tax rates. Why not take advantage of that? Bring these taxable accounts down at rock bottom low rates. Taxes are on sale. Get them while they're on sale. So the big picture plan, and that's what you have to look at, not what can I save today, because the enemy of all good tax planning is short-sightedness. I do a lot of crossword puzzles, and I come along with new words every now and then. I learned this word recently, innumeracy. It came up on a crossword puzzle. I never knew what it meant. I'll spell it. I'm going to sound like the kid on the spelling bee now. I-N-N-U-M-E-R-A-C-Y, innumeracy. It means the inability to understand math, arithmetics, calculations. In other words, a mathematical idiot, pretty much. In other words, Congress. I bring that up because I have to believe tax rates have to go up. You look at the debt and deficit levels. I don't know what the debt is today, 38, 39, 40 trillion. All I know is if they have to round up to the nearest trillion, that's a problem. At some point, the taxes have to come home to roost. You can't have mathematical illiterates running, at some point, I got to believe in math. And that's why I believe tax rates are going to go up. So if you believe like me, then you'll see the benefit of paying some tax now to get a bigger tax-free benefit later. Always pay taxes at the lowest rates. But people don't want to do that. That's why the Roth, to me, is the greatest account ever created. It grows tax-free for the rest of your life, no RMDs during your life, and even under the Secure Act, those changed rules, under the Secure Act, tax-free for 10 years beyond to your beneficiaries. So why doesn't everybody have one? Well, I'll give you 5 reasons I've discovered over time. I boiled it down to 5. There's probably 100 different reasons, but in 5 major categories why people don't convert. Number 1, I don't want to pay tax up front. Well, nobody does. But again, this will have to be paid. Every day that you don't deal with this, doing nothing is not an option. Every day you don't deal with this, it still grows and accrues and builds for your partner's share, your partner, Uncle Sam. I had a client once come in, and he was so happy that his IRA hit $1 million. And he brought me the statement, and he said, Ed, look at this. I have $1 million in my IRA. I said, give me that. That's not yours. That's just temporarily on your letterhead. You're not keeping most of that. I said, give me that. Let's say his name is Jim Smith. I wrote, there's your name, Jim Smith. It's a joint account. I wrote Jim Smith and Uncle Sam, joint owners. He said, what do you mean, joint, like me and my wife, like 50-50? Oh, no. Uncle Sam is a special kind of joint owner. He determines his percentage based on when you'll need the money most, when you take it out in retirement. We have historically low rates. I don't think you realize how good we have it. Just as a frame of reference, the years many of us were born, me, the baby boomers, 1946 to 1964. The top federal tax rate for each of those years exceeded 90%, except for the last year, 1964, when they dropped it down to only 77%. And I'm told, obviously 64, I wasn't doing this, I was 10 years old watching the Beatles on Ed Sullivan, but I'm told at that time, when they dropped the rate down to 77%, the whole country did a happy dance. Only 77% taxes, what a deal! That's more than double today's top rate. You don't realize how good you have it. I believe now is the time to strike. Yes, nobody wants to pay up front, but it's a psychological barrier. Here's what you have to do. Don't think of it as a payment. Think of it as an investment in your future financial security. You're investing. You're buying into the taxes. That's what this whole Roth thing is. It's one big, giant bet on where you think future future rates will go. If you believe like me, because I got to believe in the math, they're going to go up at some point. We just don't know when. We don't know when the music's going to stop. Or if you think you'll be in a lower bracket, then maybe it's not for you. But I believe most people will be in a higher rate in retirement. Just a show of hands. How many people think tax rates will go up? Oh gosh, that's most people, but not all people. All right, let's try it, not all people, let's try it a different way. How many of you think today's historically low rates will go even lower? Nobody. That's the same question. All right, here's the difference that I saw out there right now. We'll reconcile this right now. By a show of hands, how many of you just don't like to raise your hands? That's the difference. But if you believe they'll be higher, the Roth wins. If you believe tax rates will be even the same, Roth wins. Why? Because it has that added benefit of no RMDs for the rest of your life, plus 10 years beyond to beneficiaries. Some people say another reason why I don't convert, I'll be in a lower tax bracket in retirement. That's what people think. And logically, it almost makes sense, especially you have somebody with a high W-2, maybe they're making $600,000, $700,000. They say, well, without that W-2, I've got to be in a lower bracket. But watch the question. I'll be in a lower bracket in retirement. There's no I in team. Who will be in a lower bracket in retirement? You got to see who's going to pay the tax. You don't know what the actual eventual bracket is, where we do know the known rates today. Let me give you an example, a husband and wife. Let's say the husband's the earner, for just to say who it is. All right, now he says, I'll be in a lower bracket in retirement. That may be correct, but then he dies. Now, most couples leave everything to each other, which is probably the way it should be. So now the wife is going to have virtually the same income, actually a little less, based on the Social Security differential, basically the same income or a little less that they had when they were together. But now she has to pay at single rates. Now, are they in a lower tax bracket? No, I call that the widow's penalty. Now, if he had converted, she would inherit a Roth IRA. Yes, you have a big tax up front, but it would have been paid probably with more higher taxes later. But if you do the conversion, she will have a Roth IRA. No RMDs during life. Her income will be low for the rest of her life. And if she needs the money, it's all tax-free. And when she dies, all of that accumulation, the building, growing, compounding, will all be tax-free. And when she dies, it goes to the beneficiaries. Most of them will have to take out under the Secure Act under 10 years after death. And all of that accumulation will be income tax-free. So you get some bang for your buck. The problem is the Secure Act. Everybody's talking about the OBBBA Act. The Secure Act was the game changer. The OBBBA Act gave us some deductions that can help bring some of these costs, taxes down on taking money out of IRAs. And when I say take money out of IRAs, I'm not saying take it out and spend it. For example, don't wait till you're 73 to start RMDs. Maybe take money out in your 60s. Take it out each year. I'm not saying just take it out and blow it. I'm saying take it out, do Roth conversions. Move what I always like to say from forever taxed to never taxed. Take it out, use these low brackets every year. Every now and then I have an accountant come up to me at one of our conferences and they'll say, oh, Ed, you're not going to believe this. I kept my client in the 12% bracket. I say, I'm sorry to hear that. You didn't use the 22, 24% brackets, historically low brackets. You have to maximize them. Every year you waste a low bracket, it's lost. It's gone forever. You never get it back. You should be maximizing these low brackets. You can do that with Roth conversions, because with Roth conversions, up until they're required, the RMDs are required at 73, you can control your tax rates. And that's another key to planning. When you do it voluntarily, before they're required, you can work with your tax advisors or you figure it out for yourself and see what bracket you might come in. And you can make sure you use all these brackets. You can control your tax rates. If you don't convert, remember, this money still grows and builds and compounds for you and Uncle Sam. It's literally eroding every time it goes up. I know that's counterintuitive, but it's eroding every time it goes up. It reminds me of my dentist.
John Luskin here from the John C. Bogle Center for Financial Literacy. We're able to provide these videos from the Bogleheads conference for free thanks to generous donors like you. Consider making a tax-deductible donation at boglecenter.net/donate. Your contribution helps us continue our mission, building a world of well-informed, capable, and empowered investors. And now, back to the conference.
My dentist retired. I can't believe she retired. You know, she went to Florida. I said, how could you retire? Look at my teeth. I am your retirement plan. Are you kidding me? Anyway, she had a sign on a wall, ignore your teeth and they'll go away. It's the same thing. Ignore this growing, building IRA. It's going away in front of you. So the thing is, I'll be in a lower tax bracket in retirement. Maybe, maybe not. And that's for your own decision. But it depends who will be paying the tax. So in my situation, you could have a widow or widower getting the widow's penalty, and the tax could skyrocket. And that's assuming rates stay the same. But if you believe in math like me, what if they go up? Okay, let's say they stay the same and there is no widow's penalty for some unmathematical reason, and it goes to the kids. Well, the kids, by the time, and I say kids, may be in their highest earnings years. They may be in their 50s and 60s, and they are going to have a massive RMD in year 10 that's got half the money will be lost, even if the rates stay the same. So the Secure Act did all this. The Secure Act took away the big advantage of the IRA. For years, if you saw me before the Secure Act, I said, the IRA is the greatest asset. You can have this stretch IRA. You could go this long deferral out 20, 30, 50, 70 years. That was a deal. But Congress needed money. So what did they do? They said, the heck with that, 10 years. So now we have an end window. When you shorten, you push all this income into a shorter window, you're going to have more taxes. So when you say, I'll be in a lower tax bracket in retirement, look all the way down the line. Remember, most people want to save taxes for their lifetime and beyond, even multi-generational to the kids and grandkids. So you may not be in the lowest tax bracket. There are situations, though, I see where somebody retires, they have a big job, they retire 66, 67, and there's this one gap before RMDs begin. Once RMDs begin, then it's out of your control. You're forced to take that money, whether you need it or not. But there may be that one gap where you have low income. That may be the time to hit the Roth conversions. But once RMDs start, it's out of your control. And here's where waiting till 73, every time they throw back the RMD age. I kind of like that they keep moving it back because it's more years of Roth conversions. But most people misuse that information, say, good, more years I don't have to do anything. So the account builds and builds and builds. Then at 73, you start taking money out. And I know for a fact most people with large IRAs, they take the money out and they don't need it. So where can they put it? Well, they can't convert it to a Roth IRA, so they have to put it in a taxable account. So what did they do? This is a phenomenon I call unspent RMDs. You have unspent money, so now it's going right back into a taxable account, earning taxable interest, dividends, capital gains. So now you moved it right back into a taxable situation where those earnings could have been building in a Roth IRA. So that's another reason. Another reason is I don't want to lose tax benefits today. Again, short-term thinking. Here's what I mean. IRMA is one of the, I can't get over this. I know it's a big deal. You pay these surcharges for parts B and D based on income levels. And yes, a Roth conversion could trigger those. In fact, at one of my seminars, I do a lot of consumer programs. I had a program like this, and a woman stood up in front of the whole group and said, I love the whole idea with Roths, tax-free. Everybody loves tax-free. But I'm on Medicare, and I pay these IRMA charges. Now, what you're saying is if I convert, won't that add to my income? Yes. Well, if that adds to my income, couldn't that increase my monthly IRMA charges? I said, yes, absolutely, in front of the whole group. She said, well, if that would happen, that would make me angry. So I said to her, look, if that would make you angry, convert anyway, because I'd rather have you be angry for 1 year than be angry for the rest of your life. Because again, if you don't convert, the account still grows and grows and grows. And then when RMDs kick in, that you can't stop. She'll have that problem every year for the rest of her life, forced on her. You want to control your tax rates. And the same thing goes, you worry about short-term things, oh, I won't get this deduction or that deduction. A big item that's come up now is the $6,000 senior deduction. Big deal. All right, it's great, but it's at low levels. It phases out at around the 22% bracket. So the biggest hit you could get, the biggest tax savings you could get is about $1,300 or $2,600 in actual tax savings if it's a married couple and they each get $6,000 for being over 65. And that's in effect now. But would I not do a Roth conversion just to preserve that and leave the 24% bracket unused? No, sometimes you have to concede smaller things for bigger futures, tax-free. So you have to pick and choose. It's very difficult to project a Roth conversion for a few reasons. First of all, if you want to do a Roth conversion this year, it has to be finished this year, even though you won't know the exact bracket you'll be in until you do your taxes next year. But you have a pretty good estimate. So I would say start thinking about it, but don't pull the trigger on a Roth conversion until maybe first week in December when you get your capital gain distributions, other income, and you have a better idea of where you'll be. And then you have to factor in, it's getting very challenging now because we have a lot of moving parts, a lot of balls in the air. You have things from Secure 2.0, the new OBBBA deductions, so you have to figure those in. And those are very complicated too. They're simple, but the workings are complicated because some are permanent, some of the provisions are temporary. Some start this year, some start next year, some end in 28, some end in 29. So you got a lot of things to look at. But if the big picture plan is to get to the promised land, tax-free, then don't worry about these other things. They're just distractions. If you get them, you get them. If you don't, fine, you're doing better long term. Another objection or argument or reason people don't do Roth conversions, I talked about the first one, don't want to pay taxes now. Second one, I think I'll be in a lower tax bracket. Another one is, I don't want to, the one I just talked about, lose current tax breaks. That's short-term thinking. Another one is the opportunity cost. You know, I get this from accountants, and I'm surprised at that. The time value of money. Another situation with an accountant seminar, and a guy gets up and says, wait a minute, what about the time value of money, Ed? I said, what about it? He says, well, if I advise my client to pay all this money to convert to a Roth, that money could have been invested, and we could have made all this money. Mathematically, that is not a thing. I don't want to give you the math. I'll just tell you, you can figure it out on your own. But if rates are the same now and the same in the future, the result is exactly mathematically the same. And if earnings are the same, and you have to compare apples to apples. So that's not even a thing. And the fifth item, I said I boiled it down to about 5 reasons why people don't want to convert. And this is probably a pretty common one. People say, but Ed, can I trust Congress to keep their word? You know where I'm going. To keep their word that Roth IRAs will always be tax-free. The answer is absolutely not. Now, you know, I talked about we have this huge benefit under OBBBA. The tax cuts are extended permanently. But let me tell you what this word permanently means. In the dictionary, it means irrevocable, etched in stone, unchangeable, permanent. In the tax law, it means until a future Congress changes the rules. We have a CPA saying tax laws are written in pencil. So, could they change it? Yes, but unlikely. Why? That brings us back to that word, innumeracy. Lucky for us, Congress are the worst financial planners on earth. They're all short-term thinkers. I'm going to give you a secret here. You know what Benjamin Franklin said about secrets? 3 people can keep a secret if 2 of them are dead. I'm going to give you a secret here. Congress loves Roth IRAs because it brings in money up front. It brings in money up front. All they're short-sighted thinkers. Let's take advantage of that. They just want money up front for their budget cycles, 2, 5, 10 years. That's about it. They kick the can down the road. That'll be somebody else's problem to pay. So they love that. Why do you think, I don't know if you remember this, but before 2010, you couldn't convert to a Roth IRA if your income exceeded $100,000. Do you remember that rule? Well, Congress needed money, like they always do, back then as well. And they said, let's eliminate that rule. There's a lot of people with money that might convert. And don't you know, they got a boatload of money. They gave us the deal of the century. If you went to my programs, I begged people to take that deal because they removed that 100,000 barrier. I converted everything then. In 2010, I begged people to take that deal. It was so good. I converted everything. How much tax did I pay on my conversion in 2010? Zero. Zero. I didn't take that deal? Too bad. I begged people to take it. Zero. That's how badly Congress needed the money. If you remember, the deal was this. If you converted in 2010, you paid no tax in 2010. You paid half in 11 and half in 12. In other words, unprecedented, Congress gave us an interest-free loan to build a tax-free savings account. I begged people to take that deal. Now, I'm not an investment guy, as I told you before, but I took that deal in 2010. I look back, at the end of 2010, the market was 11,000. It's 4x now. All of those gains, absolutely income tax free. But the other deal is still on the table, low rates for as long as they might last. So I wouldn't worry that you think Congress is going to mess around with the Roth IRA. They used that to create revenue. So they created that deal because they needed money. Then they saw how much money came in. They said, what else can we do? How can we get more people to do Roths? And then they enhanced the Roth 401k, the Roth 403b. And then they went to town. They went crazy and Secure 2.0. And now we have Roth SEP IRAs, Roth simple IRAs, Roth catch-up contributions, Roth matching contributions, 529 to Roth rollovers. They want Rothomania. And for the first time next year, Secure 2.0 actually mandates, we never saw this, by law, if you're a high earner, and I don't know if that's the right term, but that's the term they use, 145,000. I don't know if that's high, but that's the number. If you're a high earner and you want catch-up contributions in your company plan in the 401k, by law, they must go to the Roth. That's the first time Congress mandated. They want their money up front, so you don't have to worry about that. And I don't think that's such a bad provision. So what? You're forced to build a tax-free, thank you, sir, give me another. But people would like to have a choice. But that shows you where Congress, the head of Congress, they're just thinking about how can they get money, and they realize that Roth IRAs are a big revenue producer. So that's how you have to take advantage. So those are 5 of the arguments I hear about Roths. Another reason where Roths can come in, if you have a large IRA, and a lot of what I'm talking about is really for people that have large IRAs, 500,000, $1 million or more, because the larger your IRA, the more likely it is more of that will be left over beyond your life, and more likely that the kids are going to take the big hit in year 10 under the 10-year rule. And that's what Secure Act did. Secure Act actually made IRAs the worst possible assets to use for wealth transfer and estate planning. They made it from the best to the worst. So a Roth is a good alternative. If you're charitably inclined, that's an alternative. So while IRAs may be the worst assets for wealth transfer and estate planning, they are the best assets now to leverage, to bring these balances down into better places. Roth IRAs, charitable planning. IRAs are the best assets to give to charity. There's just no question. For example, I don't know if you've looked at your own wills or anything, but if any of you have a bequest in your will to a charity, get rid of it. Redo your will. Why would you give good money to a charity? Give them the dregs. Give them your IRA. And leave better money that gets a step up in basis to your beneficiaries. Reverse the bequests. For example, you have $10,000 to your church in your will. All right, leave the church $10,000 of your IRA and let the kids have better money that gets a step up in basis. IRAs don't get a step up in basis. Here's another idea you can do. You may have people, that could be you, and you're doing well, but you have a parent. This is what I call, you don't hear this too much, but I've used this with clients. I call it reverse estate planning, gifting up the family tree. Here's the way this works. So if I have a client, they come in, they're at a high bracket, but their mother has a Roth IRA and she's in her 80s. Mother has a regular IRA and she's in her 80s. I said, here's what you should do. Have your mother convert her IRA to a Roth, but her mother doesn't have the money. You gift her the money. You gift her the money, she converts that to a Roth IRA at her low bracket. The only thing is, make sure she names you as the beneficiary. Then you get the money, but the tax was paid at her rate. See, people don't think outside the box like that. There's so many ways, but the point is to leverage this IRA. With the charity, you can do QCDs, one of my favorite provisions, qualified charitable distributions. A distribution, a direct distribution, if you're 70 and a half or older, from your IRA to a charity. Or if you want to leave money to a charity, you can leave an IRA to a charity or a charitable remainder trust. And speaking of trusts, that's another area. Some of you with large IRAs have named a trust as a beneficiary. That was okay. I recommended it before the Secure Act. Secure Act destroyed that strategy. Why? Because the trust no longer works. If you have one of these conduit trusts where you leave your IRA to a trust, it no longer works because the trust is also a non-spouse beneficiary subject to this 10-year rule. And if you look at the trust rates, After about $15,000, you're at the top rates. They're compressed, highly taxed rates, whereas an individual won't get to that point till about $600,000. So why do people name a trust? And that's a question I get. Ed, when should I name a trust as my IRA beneficiary? And that's easy, when you don't trust. Because if you trusted them, you wouldn't need a trust. They should have called it a don't trust. That's when you name a trust, when you don't trust. So for example, I had a guy, a $3 million IRA, a client, and he said, look, I got $3 million in this IRA. I don't even need that money. I want it to go to my kids and grandkids, but I don't want them blowing it. It took me too many years to work for this. And all the parents, it's what they're worried about all the time. Divorce, bankruptcy, litigation, can't handle money, squandering it. And they work so hard for it. The number one thing I used to get from clients, they used to tell me, it's not my kids I worry about, it's the ones they marry. Seriously, so that would be a reason to name a trust when you don't trust, to make sure. And that worked before the Secure Act, because you could still get the stretch IRA through the trust. So the clients liked that because the kids would get the trust, the conduit trust said RMDs go out to the kids. But they were little crumbs, even on large IRAs, because the kids were, might have been younger and so forth. But the lion's share was protected in the trust. If that trust was not changed after the Secure Act, in year 10, you have one RMD, 100% RMD, the very thing this guy wanted. So let's go back to this guy. He had $3 million. $3 million in an IRA. Maybe by the time he died, it was $5 million. By the end of the 10th year after death, it was $10 million. He set up the trust because he didn't want these kids blowing it. If that trust is not changed under the Secure Act, now he dies, that $10 million goes right out to the very beneficiaries he didn't want getting their hands on the money. It's no longer protected. Now, you could have a trust that protects it and holds it in the trust, but then you get hit with trust taxes. What's the answer? You convert to a Roth IRA and leave the Roth IRA to the trust. I'm not saying don't use a trust. You still need protection and control. But you convert means paying tax now. But remember, it's not if but when. That tax will have to be paid at some point, at some later date. We have known rates now we can take advantage of. So you convert, and if you have that situation where you need control, you leave the Roth to the trust. And the Roth, is still same rules apply. It has to come out and into the trust by the end of the 10th year after death. But it's all tax-free. Now all that compounding, you got rid of the trust tax, and you got the control. I found when I've talked to people over the years, and I did this for 40 years, tax and estate planning, when I would ask them what they want, why you're here, it would always come down, they didn't say it exactly, but some version of these three items. Larger inheritances for my beneficiaries, more control, because I don't trust my beneficiaries, and less tax. Larger inheritances, more control, and less tax. I call that the promised land. And you can get there by leveraging this large IRA, bringing it down while rates are low. Get taxes while they're on sale. Don't worry about what it costs now. That's small potatoes, a rounding error. Think with the end in mind. Plan with the end in mind. Anybody here from Atlanta? You can admit it, it's okay. Yeah. What street do you know in Atlanta? Peachtree, that's the whole point of this, all right. There's no imagination there. Every street is Peachtree. Actually came up on another crossword. 71 streets in downtown Atlanta have Peachtree in the name. So we were at a program once. I had time to walk around, and I mistakenly asked somebody for directions. Oh, that's on Peachtree. Oh, that's a help. Well, what's the cross street? Oh, it's on Peachtree and Peachtree. Really helpful. So if you come to the right Peachtree and Peachtree like I did, you'll come across the Margaret Mitchell House. About 90 years ago, she wrote the classic Gone with the Wind. It's a museum now, and if you go there, you find it took her 10 years to write this book. But what I found really amazing, she wrote the last chapter first. She began with the end in mind. That's the key to all tax planning. Move from forever tax to never tax. Find out where you want to go. Get your plan, not the government plan. You want to be in control. Thank you all very much, and now I'll take the questions. Thank you. Tell us what they have, Mike. I can't wait for this.
Yes.
Go ahead.
Many, many more questions.
Oh, yeah.
So first question, you mentioned qualified charitable distributions.
Yeah.
And leaving an IRA to a charity as a beneficiary. How does that affect the decision of whether to do Roth conversions or not, if you have plans like that?
No, well, it doesn't affect, you only have so much. If charity, you always prioritize. That's a great question because it goes into the theme of what I was going to say. Where do you want to end up? If charity is in the big picture planning, obviously that comes first because that's what you want to do. I wouldn't say, I'd rather spend more money on a Roth conversion. The heck with the charity. And by the way, when I talk about charity, I always make sure to say for charitably inclined people. I don't know if I said it when I did it earlier, because I found in practice, people sometimes think who aren't charitably inclined that they're just in it for the tax benefits. But when they find out you actually have to give the property away, they say, well, the heck with that. So if you're giving to charity anyway, IRAs are the best thing. So I don't think one has anything to do with the other. You can do both. Okay. But wait a minute. Don't ever give a Roth to a charity. Give them the dregs. Remember, Roth is too good. Give them the bad stuff.
If you convert all of your tax-deferred accounts to Roth, that may leave you in the 12% or possibly even 0%
That is a great question. I was hoping somebody would ask that. So I said always pay taxes at the lowest rates. And then I said make sure to never waste. So you may want to keep some, that's why this is a great question. You may want to keep some traditional IRAs for giving to charity, or to use up these new standard deductions and some of these new OBBBA deductions. So you may want to keep a bedrock of traditional IRAs if you can get them out at lower rates. Remember, when you get money out for charity, it's coming out at 0%. If you get money out and you can lower the rate with a traditional IRA, you should do it. Or you may want to keep, and this is a tough one, you may want to keep traditional IRAs if you have future medical bills. Nobody knows, but everybody knows. There will be medical bills. So if you have high medical bills, you want to have some IRA money to use. So I know there's the 7.5% differential, but other than that, at least you get some tax offset. So there are reasons to keep a bedrock of traditional IRAs.
Which money do you recommend using to pay the tax on the conversion?
Oh, which money? Outside money, especially if you're under 59.5. Never have tax withheld on a Roth conversion before 59.5, because then, can you imagine this? This is a deal breaker to me, because then you'll get hit with a 10% penalty. You're going to pay a penalty for paying taxes. That just doesn't work. Now, you could do it after 59.5. There's no more 10% penalty. But still, you don't get the bang for your buck. If you want to convert $100,000 and you hold back, say, $30,000 for taxes, you're paying for 100 but only getting 70. So always outside money. But if you don't have it, this question comes up. The best policy for you is, again, look at your brackets every year and maybe a series of smaller annual conversions over time.
If you're retired
Yeah.
and Social Security and RMDs haven't started yet, so your income has gone down, but you're not on Medicare yet, so you're buying insurance on the marketplace, should the premium tax credit factor into the
Oh boy,
whether
I don't
to
even want to
convert?
get into that discussion. That's why we have no government now. So for one more year, maybe that's a thing. I mean, it's true. You have to pick your battles. That's why I said there's so many balls in the air. See what's most important to you. We may only have one more year that's premium tax credit. Who knows? But if that's a big deal, obviously it comes into the whole group of what if I can't afford a conversion? Like a lot of seniors say, should I convert at 70, 80 years old? Not if you're doing it for yourself. The upfront cost versus, sorry to say, your limited life expectancy, just not worth the benefit. But if you're converting for your children and grandchildren and paying the tax doesn't impact you, that's a good move. But if you don't have money, nobody should go broke converting.
What about contributions rather than conversions? Do you recommend typically contributing to a Roth 401k over a regular 401k?
Oh, yeah. Oh, I'm glad you asked that, because here I'll get a lot of, well, you wait till I say this. Stop contributing to your 401ks and IRAs. What? I saw that look. Why on earth would, I just said it's the worst account. We're trying to bring it down. Why would you put gasoline on the fire? So with the 401ks, people say, yeah, but the deduction. It's not a real deduction. It's a fake deduction, okay? Here's why I say it's not a real. To me, a real deduction is something you get to keep. You deduct mortgage interest, you get that benefit, you don't have to give it back. You deduct charity or medical, you get that benefit, you don't have to give it back. A deduction, I don't even like to call it, it's an exclusion from income when you contribute to a 401k. All that is to me is a loan you're taking from the government that has to be repaid at the worst possible time. That's all it is, you have to give that back. Plus, it's not good for tax planning. In good tax planning, you take deductions when rates are high. You take income when rates are low. Why would you take deductions when you get almost no benefit out of them because of the low rates? So then somebody else will say, all right, you got me on the deductions, but what about the company match? That's free money. The law has changed. That can go to the Roth 401k. And by law, for high earners, they force you to do that to the Roth 401k. And the same theory with IRAs. Why add to the problem? And young people should only, you tell your kids and grandkids, why on earth they join a company and they put them in the 401k? They're at low brackets in their earliest earning years. Why? The deduction is meaningless and they're building a taxable account. Young people should only be doing Roth 401ks at work or Roth IRAs. So here's my advice to the young people, like my daughters, the millennials. Stop taking pictures of your food and open a Roth IRA. I have pictures of every meal my two girls have ever eaten. And then you can't be rude. You have to answer, oh, I'm so proud. Go ahead.
When doing conversions, are you usually recommending that we convert the whole thing in a lump sum or over time?
That's your personal preference. I kind of like ripping the Band-Aid off while the rates are here. Again, we do have permanent rates, but you can manage them. You're probably better off. I'd be happy, I think you'd be happy if you could max out the 24%, which is an unbelievably low rate in comparison to what we had in the past each year. So you do a series of smaller conversions. But let's say you have an aberration year. You know, we had this in COVID. And for business owners, you got to look at, there's benefits like under OBBBA I didn't get into, the QBI deduction. You may not want to convert too much to blow that deduction. But we saw business owners that had these pass-through entities, S-corps, partnerships, LLCs, and they were hurting. Some of them had, 100, 200,000 loss pass through, negative income. Yes, convert everything, because they could have converted. And I heard from accountants, they said, my client, he shows a $100,000 loss. And you didn't convert, you could have converted 100, 200,000 for free. You got to take advantage of events. So it's a personal thing. On some people, I had clients that when Roth just came out, they said, they hated RMDs so much, they just converted everything to avoid RMDs. So it's your personal preference. But at some point, this money will be taxed, and you have to manage the taxes by taking control of them. Before, it's out of your control when RMDs are required. And another thing on that, RMD, the M in RMD stands for minimum, but it doesn't stand for maximum. What I would say is take the most out. Don't always wait for the minimum. What good is the minimum in anything in life? Oh, you go for a job, right? I'd like to do the absolute minimum. What do you have for me? Think maximum. How much can I get out of this IRA? Even before it's required to max out the low brackets. Change your thinking. Oh, we're having a summit here.
Yeah. We're going a little bit past time, and we were told
I'm
that that's
good, but
okay.
I don't want to wreck the program.
No, we were told to keep going for a few more minutes.
That's up to you. I like when he's the bad guy. See, I say, I'll stay here forever, but that bad guy, he wants me to leave.
Once RMDs kick in,
Yeah.
So two separate but similar questions. Is it too late to contribute to a Roth IRA, and is it too late to start doing conversions to a Roth
They are separate questions.
Right.
All right, let's take the bigger one, because I didn't cover that. I said try and get the conversions in before RMDs kick in, because they cost more once RMDs kick in. RMDs cannot be converted, but the first dollars that are out of your IRA in any RMD year are deemed to first satisfy the RMDs for all your IRAs. That was new. That came out of the Secure 2.0 regulations and the final regulations of Secure. You have to first satisfy all your RMDs from all your IRAs, then, and pay tax on that money, and that money can't be converted. Once that's done, yes, you can convert any part or all of the balance, but it costs more because you had to pay tax on money you couldn't convert. And another thing people miss, some people tell me, well, I'm not going to do that. Let my beneficiaries handle it. They can convert. No, they can't. That's another common question we get. An inherited IRA cannot be converted to an inherited Roth. But there's an unintended aberration in the tax code. If you inherit a 401k, you can convert that to an inherited IRA, but not an IRA. So really the parents or grandparents have to do it for you. And the other question, can you contribute to a Roth IRA? Yeah, if you qualify under the limits and you have earned income. And even if you don't have earned income, you can do the backdoor Roth. I mean, you still need earned income. Even if you're over the income limits is what I mean. You could still do the backdoor Roth.
Can you recommend any software or educational resources for Roth
There's
conversions?
lots of software out there, and I saw on the Bogleheads some mentioned certain companies, but it's the same thing as everything, garbage in, garbage out. I'm hearing from tax advisors that the new software that's coming out, I don't want to mention names, but all of them, based on the OBBBA law, the new extension of the lower rates, they say it's not working in their long-term projections. Why? Because a computer only does what they plug in the law. And the law says these will be the extended low rates permanently. So the computer assumes you'll always be in a 22, so no reason to convert, because this is going to go on forever. The computer also doesn't understand what the word permanent means in tax law. But the computer is also biased by the input. That's what I found. Early on, when we started trying to do that with clients, we found that the ones who didn't want to pay the tax to convert always, because you have to assume a future rate. They said, my rate will be low. They would kill their own Roth conversion. They'll say, oh, I'll be in a 10% rate or whatever. All right, oh, the computer said don't convert. So you have to input your future rate, which nobody knows. So, unless you're honest with yourself, it doesn't work.
All right, there's a million more questions, but I think
A
we should
million
wrap up.
more. I don't have time for a million more. But I want to thank you, all of you. It's been a great experience. My first time here. Thank you very much. Thank you. Thanks, Christine.
If you enjoyed this video, we have dozens more on personal finance and investing available on this channel. Hit that subscribe button to get notified when we release new content, including our monthly podcast, Bogleheads on Investing, and more conference sessions like this one. To watch more right now, click the video card on your screen.